Most people enter the stock market with the same dream. They imagine financial freedom. They imagine their money growing while they sleep. They imagine finding that one great investment that could change their life forever. The idea sounds simple: buy good assets, hold them, and watch them grow over time. But reality tells a very different story. Studies often suggest that nearly 90% of traders lose money in the stock market. Not because the market is impossible to understand, and not because investing is only for geniuses. The real reason is much simpler. Most investors fail because they cannot control their psychology. The stock market is not just a financial system. It is also a giant emotional machine. It constantly tests patience, fear, discipline, and greed, and most people fail this test. This creates a strange paradox. The stock market itself has historically grown over long periods of time. Entire economies have expanded, industries have evolved, and companies have multiplied their value many times over. Yet millions of investors still struggle to build wealth from the market. If the market continues to grow over decades, then why do so many investors fail to benefit from that growth? The answer lies in human behavior. Most investors enter the market with the wrong expectations. They believe investing is a shortcut to quick money. They imagine finding a stock that doubles within months. Social media makes this belief even stronger. Every day there are stories of people making huge profits from trending stocks, cryptocurrencies, or viral investment ideas. These stories create the illusion that successful investing is about finding the perfect opportunity at the perfect time. So beginners start chasing the next big thing. They follow influencers, search for stock tips, and read headlines predicting massive profits. But by the time something becomes popular enough to appear in the news or on social media, the opportunity has usually already passed. Prices have already risen dramatically. Instead of buying early, most people buy at the peak of excitement. And that is where the emotional cycle of investing begins. When markets rise quickly, confidence spreads everywhere. News headlines become optimistic. Friends begin talking about profits. Social media fills with screenshots of massive gains. This creates a powerful emotion known as FOMO, the fear of missing out. Investors begin thinking that if they don't act immediately, they will miss the opportunity of a lifetime. So they buy, but markets never move upward forever. Eventually, prices fall. Sometimes the drop is small. Sometimes it is dramatic. And when prices begin to fall, the emotional environment changes instantly. Excitement turns into fear. The same investors who were confident yesterday suddenly begin questioning everything. They watch their portfolio lose value and panic. News headlines begin predicting economic collapse. Social media becomes filled with negativity and warnings. And under this pressure, many investors make the worst possible decision. They sell their investments when prices are already low. This creates the classic investing mistake: buy high and sell low. Ironically, successful investors do the exact opposite. They buy when prices are reasonable and remain patient during market volatility. But doing this requires emotional discipline, something many investors struggle with. Another reason investors fail is their obsession with short-term results. The stock market moves every day. Prices fluctuate constantly. Watching these movements can create the illusion that investing requires constant action. Many investors begin checking their portfolio several times a day. Every small movement suddenly feels important. A slight drop creates anxiety. A small rise creates excitement. This emotional roller coaster leads investors to trade more frequently, hoping to capture quick profits. But this behavior usually reduces long-term returns. Short-term price movements often have little connection to the long-term success of a company. Businesses grow through innovation, leadership, and customer demand. These processes take years to develop. Yet many investors judge an investment based on what happened during the last few days or weeks. Successful investors approach the market differently. They understand that buying a stock means buying a piece of a real business. When you purchase shares of a company, you are not just buying a number on a screen. You are becoming a partial owner of that company. This mindset changes everything. Instead of asking, "Will this stock go up tomorrow?" successful investors ask deeper questions. Is this company strong? Does it have a competitive advantage? Will it still be successful 10 years from now? This long-term thinking separates the majority of investors from the minority who succeed. One of the most powerful forces in investing is compounding. Compounding occurs when an investment generates returns, and those returns begin generating additional returns. At first, the growth may appear slow, but over time it accelerates dramatically. A famous example of this principle can be seen in legendary investors who started investing early and allowed their investments to grow for decades. Their wealth did not appear overnight. Instead, it expanded slowly and steadily through the power of compounding. Time becomes the secret ingredient. Investors who constantly buy and sell interrupt this compounding process. Those who remain patient allow their investments to grow exponentially over long periods of time. Patience, therefore, becomes one of the most valuable traits an investor can develop. But patience alone is not enough. Successful investors also follow clear strategies. They focus on strong companies with sustainable advantages. They look for businesses with stable profits, capable leadership, and long-term growth potential. They understand that great companies create value over time. Another important concept is diversification. Successful investors rarely place all their money into a single investment. Instead, they spread their investments across multiple companies, industries, or asset classes. Diversification reduces risk because the success of one investment can balance the weakness of another. This approach creates a more stable portfolio capable of surviving market fluctuations. Education also separates successful investors from the rest. The most successful investors spend years studying markets, companies, and financial systems. They read books, analyze financial statements, and learn from past mistakes. This knowledge helps them make informed decisions instead of relying on speculation or rumors. Over time, this understanding becomes a powerful advantage. However, the most important difference between successful investors and unsuccessful ones is emotional control. Markets will always experience volatility. Prices will rise and fall unpredictably. News headlines will constantly predict either prosperity or disaster. Investors who react emotionally to these changes often make costly mistakes. Those who remain calm and disciplined are more likely to stay on track. Emotional control allows investors to think clearly when others panic. It allows them to hold strong investments during downturns and avoid chasing hype during booms. This discipline may not feel exciting. In fact, successful investing is often surprisingly boring, but boring strategies frequently produce the best long-term results. Buying strong companies, holding them patiently, and allowing compounding to work over many years has historically been one of the most reliable paths to wealth. The difference between the average investor and the top 1% is not a secret formula. It is a set of simple principles applied consistently over time. Successful investors think long-term. They ignore short-term noise. They avoid chasing trends. They focus on strong businesses. And most importantly, they control their emotions during both good times and bad. Becoming part of the 1% of successful investors does not require extraordinary intelligence or secret information. It requires patience, discipline, and a willingness to think differently from the crowd. Most people approach investing with the goal of making money quickly. The most successful investors approach it with the goal of building wealth slowly and steadily. In the end, investing is less about predicting the future and more about controlling yourself in the present. The market will do what it wants. It will rise, it will crash, and sometimes it will confuse even the smartest investors. But if you can master your own emotions, follow a disciplined strategy, and allow time to do the heavy lifting, you will not only survive the market, you will benefit from it, because the real secret of the 1% is not what they buy. It is how long they are willing to wait. And if you can develop that patience, you will already be thinking like the investors who build wealth over decades. So the next time the market becomes exciting, chaotic, or frightening, remember one simple rule. Wealth is not built in moments of excitement. It is built through years of discipline. If you are ready to start thinking like the top 1% of investors, write 1 in the comments. Because successful investing does not begin with a stock. It begins with a mindset.